The markets are closed. The ticker tape has stopped moving. The final price on your screen glows at $71.91. For many of you looking at this number, there is a sense of hesitation. For a generation of investors who watch silver bounce between $15 and $20 for decades, $71 feels wrong. It feels like a peak. It feels like a bubble waiting to burst. You look at your portfolio and you feel a sense of vertigo. You think that because the price has gone up, it must come down. You think that you have missed the boat, or worse, that you're about to fall off a cliff. But I am here to tell you as a financial expert that your perception is lying to you. Your brain is calibrated to a financial world that no longer exists. You are measuring value with a ruler that has shrunk. The $71 price you see today is not expensive. In fact, when we look at the data through the lens of history and mathematics, silver remains one of the cheapest assets on the face of the earth. We are not witnessing a speculative bubble. We are witnessing a fundamental repricing of reality. To understand why $71 is not the top, but rather the new floor, we must perform a forensic audit of the dollar itself. Money is supposed to be a measuring stick for value. But since the 1970s, that stick has been changing length every single year. When you say $71 is high, you are comparing today's devalued currency to the ghost of a currency that had real purchasing power 40 years ago. We are at the beginning of a massive structural squeeze that is far bigger, far more dangerous, and far more permanent than anything we have seen in our lifetimes. The rocket has cleared the tower, but it has not even reached the stratosphere yet. To understand where we are going, we first have to understand the trauma that haunts this market. We have to go back to the winter of 1979. The world was in chaos. Inflation was running rampant. The United States dollar was under attack, and oil prices had quadrupled. Trust in the system was at an all-time low. In that environment of fear, three brothers from Texas decided to do something audacious. Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt. They were oil tycoons who understood one fundamental truth. Paper is smoke, but silver is real. The Hunt brothers accumulated a position so massive that they controlled over 100 million ounces of physical silver. Their buying created a feedback loop. The price went from $6 an ounce in early 1979 to nearly $50 an ounce in January of 1980. That number, $50, became the ultimate ceiling. It became the Everest that the market could never climb again. For 45 years, every time silver rallied, the ghost of 1980 returned to scare investors away. The crash was brutal. The government and the exchanges changed the rules overnight, raising margin requirements and forcing the Hunts to liquidate. The price collapsed from $50 to $10 in months, destroying fortunes and creating a psychological scar that lasted 2 generations. But here's the critical data point that the history books ignore. The $50 of 1980 is not the same as the $50 of today. If you had $50 in your pocket in 1980, you could buy a week worth of groceries for a large family. You could fill your gas tank 5 times. Today, $50 barely buys a steak dinner for one person. When we compare $71 today to $50 in 1980, we are making a massive category error. We are comparing apples to oranges. According to official government statistics, $1 in 1980 has the same buying power as $3.50 today. This means that to simply break even with the 1980 high, silver would need to be trading at $175 right now. At $71, we are still trading at a 60% discount to the real historical high. The fear you feel is based on a nominal illusion. The reality is that we are still in the bargain basement. Let us look deeper into the math of the dollar. We must realize that inflation is not just a percentage on a news report, it is the slow-motion destruction of your labor. Even if we use the government official Consumer Price Index, which many experts believe is heavily manipulated to understate the truth, the story is staggering. Since 1980, the United States has printed tens of trillions of dollars. In 1980, the total amount of money in the system, known as the M2 money supply, was roughly $1.5 trillion. Today, that number has exploded to over $21 trillion. The supply of paper dollars has increased by 14 times, yet the supply of silver above ground has remained remarkably stagnant. If silver had simply kept pace with the growth of the money supply since the 1980s, the price would not be $71. It would be well over $300 an ounce right now. When you see $71 on your screen, you are seeing the result of decades of price suppression through paper contracts on the futures markets. But the physical reality is finally breaking through the paper facade. If we adjust for the actual cost of living, including housing, healthcare, and education, the purchasing power of the dollar has collapsed far more than the government admits. Silver at $71 is not a luxury. It is a mispriced insurance policy. If you could go back to 1980 and buy an asset at a 60% discount while the rest of the world was in a panic, you would do it in a heartbeat. That is exactly the opportunity sitting in front of you today. We are not at an all-time high. We are in a massive historical dip that is disguised by nominal numbers. The second reason why this rally is different from 1980 is the nature of the demand. In the days of the Hunt brothers, silver was primarily used for photography and silverware. Photography was a chemical process that used large amounts of silver. However, it was also price sensitive. When the price hit $50, people stopped taking as many pictures, and companies like Kodak found ways to recycle the silver from developing fluids. The high price fixed the shortage. Today, the world has changed. We have moved from the age of photography to the age of electrons. Silver is the most conductive element on the periodic table. It is not just a shiny metal, it is an essential industrial grain. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. You cannot build a 5G tower or an artificial intelligence data center without silver. Crucially, these modern industries are price inelastic. This is what I call the salt in the soup effect. If you are cooking a massive pot of soup, you only need a small pinch of salt. If the price of salt triples, you do not stop making the soup because the salt is a tiny fraction of your total cost, but it is absolutely essential for the flavor. Silver is the salt in the high-tech soup. An iPhone contains a tiny amount of silver, perhaps worth $1. If the price of silver goes to $200, the silver in that phone might cost $3. Will Apple stop making iPhones over a $2 price increase? No. Will a solar farm developer stop a billion-dollar project because the silver components cost a bit more? No. This means there is no natural ceiling to the price. In 1980, high prices killed demand. In 2025, high prices will not stop the green energy transition or the AI revolution. The world will pay whatever the market demands because the alternative is technological collapse. We have engineered a world that is addicted to silver, and the dealers are running out of supply. One of the greatest myths in the silver market is that as the price rises, a massive wave of recycled metal will hit the market and crush the rally. In 1980, this was true. When the price touched $50, people lined up at refineries to melt down their family heirlooms, sterling silver tea sets, and vintage coins. This secondary supply acted as a safety valve that capped the price. But in 2025, that safety valve is rusted shut. We have spent the last 40 years consuming the world above-ground silver stocks. Most of the silver produced today is not sitting in a vault in the form of a heavy bar. It is dispersed in billions of electronic devices. It is in the microscopic layers of your smartphone, the silver conductive lines in solar panels, and the tiny switches in your car. Unlike a silver spoon, these nano applications are not economically recyclable. To recover a fraction of a gram of silver from a discarded laptop requires complex chemical processes that cost more than the silver is worth, even at $100 an ounce. We have essentially eaten our seed corn. The vast reservoir of scrap that saved the banks in 1980 and 2011 no longer exists. Furthermore, the mining industry cannot simply turn on a faucet to create more supply. Silver is primarily a byproduct of copper, lead, and zinc mining. Even if the silver price doubles, a copper mine will not increase production unless the copper price justifies it. The earth is getting stingier. The average silver grade in global mines has fallen by over 70% in the last few decades. We are facing a permanent physical deficit that has been building for 5 consecutive years. Higher prices are no longer bringing out more metal. They are simply confirming that the cupboard is bare. To understand the explosive potential of silver, we must look at its relationship with gold. This is the gold to silver ratio, the most reliable clock in the history of finance. For thousands of years, The ratio between these two metals was roughly 15 to 1. This was not a random number. It reflected the actual ratio of the metals found in the Earth's crust. Even during the peak of the 1980 mania, the ratio reached 17 to 1. Today, as gold trades near its all-time highs of $4,500, silver is sitting at $71. This puts the current ratio at approximately 62 to 1. This is a massive historical anomaly. It means silver is trading at a fraction of its true monetary value relative to gold. If we simply return to the 2011 ratio of 30 to 1 and gold stayed exactly where it is today, silver would have to double to $150. But gold is not staying still. Gold is breaking out as central banks around the world dump the dollar and buy real assets. If gold moves toward $5,000 or $6,000, silver will act like a high beta play on gold. It always moves faster and it always moves harder. In a bull market, silver is like a coiled spring that has been pinned down by paper manipulation for decades. When that spring is finally released, it does not just return to normal, it overshoots. When the ratio finally collapses back toward its historical mean, those holding silver will witness the greatest transfer of wealth in modern history. You're not just buying a metal, you're buying the most undervalued monetary asset in existence. The final and perhaps most explosive difference between the past and today is the geopolitical landscape. In 1980, the United States was the undisputed master of the financial world. The London and New York exchanges controlled the global flow of metal. When the price of silver became a threat to the dollar, Washington and Wall Street had the power to change the rules and crush the market. They had the kill switch. Today, that kill switch is broken. The world is fracturing into a multipolar system. The United States no longer dictates the price of silver because the physical demand has moved to the east. China is now the largest consumer of industrial silver in the world. India is the largest importer of silver for investment and jewelry. These nations, along with the BRICS alliance, are not playing a short-term speculative game. They are engaged in a strategic resource war. China is not buying silver to trade it for paper dollars on a screen. They are buying it to back their massive energy grid and to shield their wealth from the collapse of the Western debt system. They are moving their reserves from United States treasuries into hard assets. This is why we are seeing the emergence of the Shanghai Premium, where the price of physical silver in the East is consistently higher than the paper price in the West. The physical metal is refusing to stay in Western vaults. It is flowing to where it is valued most. You cannot margin call a superpower. You cannot force China or Russia to sell their strategic reserves. The pricing power has shifted from the bankers in London to the industrialists and central banks in the East. This creates a solid floor that did not exist in 1980. The East is buying every dip, and they are playing for keeps. We must now address the elephant in the room, the $100 trillion bond market. For 40 years, investors have treated government bonds as a safe haven. But as the United States national debt crosses $36 trillion and interest payments exceed the defense budget, the bond market is beginning to realize the math is broken. The system is mathematically insolvent. The only way the government can pay its bills is by printing more money, which further devalues the dollar. When the bond bubble finally bursts, that ocean of capital will search for a tiny lifeboat. The total value of all the silver in the world is less than $100 billion. It is a microscopic drop in the ocean compared to the bond market. If even 1% of that bond money tries to move into silver, the price will not just rise, it will gap up in a way that makes $71 look like a distant memory. We saw a preview of this on Christmas Eve when the sellers simply vanished and the price jumped 5% in a single day. The market is closed right now, giving us a rare moment of clarity. Do not be distracted by the daily volatility. Do not let the ghost of 1980 frighten you into selling your position. You are holding a strategic, essential, and finite asset in a world of infinite paper debt. The industrial world needs your silver. The central banks in the East want your silver. The failing bond market will eventually crave your silver. $71 is not the summit, it is the base camp. We are repricing silver to reflect its role as the indispensable element of the 21st century. Hold for the true valuation, hold for the history books. On Monday, the game resumes, and the math is on your side.